Before I dive into the, I guess, triple witching or whatever, and whatever else is going on, I noticed, Chris, that Goldman's derivatives team this week put out a note warning they think we could see a big drop in the S&P in the next month. Would you be on a similar wavelength to that or no?
Well, I mean, I do think that the options, what they were saying, the options are underpricing the chance of a big drop. You know, volatility has obviously come in a lot, and correlation is so low. Everything's moving in different directions that the S&P is not moving nearly as much. So I would agree that the options are underpricing the odds of a sharp move lower, but I don't think it's a huge probability either way.
Bob, how big a deal is I take it we don't have a quad witching anymore because there's no single stock futures? Explain to us what's going on today.
That's right. That's right. So this is two events happen today. It happens 4 times a year. This is an expiration day. It's now a triple witch. A triple witching is the quarterly expiration of stock and index options and index futures. We used to have single stock futures as well. There's really none of them left, so that's why it's called a triple witch. This is not so much of a big event as it was 10 or 20 years ago because there are so many different kinds of options out there, including weekly options, monthly options. There's even options that expire on the same day. So there's a vast universe of people who want to participate in derivatives who used to just have to use these quarterlies and now can use other ones. I think the more interesting one is potential rebalancing at the close. We're going to have Palo Alto Networks kind of going into the S&P 500. That's kind of a big thing. We're going to see Dish come out. And then there'll be a rebalancing around companies who have been reducing their share count. Companies like Apple and Meta have been aggressively reducing their share count. So the indexing companies that are out there, the S&P 500 index firms that Vanguard uses, iShares use, they're going to be reducing their share count there. I think that would be interesting towards the close. I don't think we're going to see a lot of price movement, but we might. We'll definitely see a lot of volume. In fact, even today, we're seeing much heavier than normal volume.
Interesting. Chris, let's talk about some of the FOMO you're seeing in options. Maybe it's in the semi space I mentioned. How would you take advantage?
Sure. Yeah, we're seeing the upside calls really bid up as everyone's kind of chasing that performance and wants to be involved. So what we're going to want to do is, a lot of these, the IWM and the SMH, they've had a pretty big run already. So you might be a little bit nervous getting long here because of how much downside you see on the chart. So you're going to want to look at a call spread. So that's going to be buying a closer to where the ETF currently is call and taking advantage of those further out of the money calls. Those are really bid up. And in a call spread, you're selling those out of the money calls. So we're setting up a call spread, very limited cost. You know what your risk is, the price that you paid. You don't have the downside of the ETF pulling back, and you get in for a pretty good price because you take advantage of those upside calls that are really bid up.
I also noticed you're watching an area that I'm kind of shocked at or I admire. I don't know what word to use. Delta is about to be up for the 16th straight session in a row. Are you seeing people now trying to lean against that, or are they pushing into that strength?
It's interesting. A little bit of both. So the Jets ETF, which is a bunch of the airlines, we are seeing some decent-sized put trades there. Most likely, long airline players who are pretty happy about the move that's been made and they want to hedge some of it. On the flip side, in Delta and United Airlines, we're seeing investors sell a downside put, basically saying, shoot, we missed this rally, but we'd love to be involved on a pullback, but also buying a upside call spread. So using that put to finance the upside call spread and saying, if this thing keeps moving higher, I want to be involved as well. So that's a pretty attractive strategy when you're saying, I'd love to buy a pullback, but I also don't want to miss a rally.
Bob, let me just turn to you with kind of the bigger picture here, which is that the S&P is basically back to where it was when the Fed first started hiking. And I don't think anyone had that on their bingo card.
Yeah, here's what you need to ask right now. What is the catalyst for a pullback? I know you've had some doom and gloomers on recently. Ask yourself, what is the catalyst for a potential pullback? I don't mean 5% decline in the summer. Duh, that happens all the time. Yeah, that is not an interesting prediction. The S&P is up 15%. What would it take for it to be flat in the next 2 months? I mean, think about it. And it's right now, it's hard to think like the S&P would go back to flat in the next couple of months. Everybody screams at me, the valuations are high. Well, that is true. However, earnings estimates are starting to rise again. If that happens, you can argue for a valuation. The big issue is the soft landing is winning, and that's the single most important thing. Employment remains strong, earnings are holding up, interest rates look like they're topping out, and we didn't even drop when the Fed threatened to do a couple of more additional rate hikes there.